Well, it's official. Tesla's growth story is dead. At least according to some on Wall Street who are saying exactly that. But you guys come here for the truth, and the truth is there are some very valid points made by these Wall Street guys, so I cannot say it's all crap either. So let's discuss what specifically they cited as to why Tesla's growth is dead, and I'll tell you whether or not it's true or not, and I'll give you my take on Tesla's growth and what the heck is going on right now with it. Just make sure you like the video if you like getting the truth without the hype. And don't forget about the pinned comment down there where we talk about financial freedom and retiring early. That's the pinned comment down there. That right there is where you find that sort of content. All right, so let's get into the article right here. I'm going to kind of cut the crap. They give a whole bunch of the background on Tesla and everything else. We don't need that at this stage. Let's get to the specifics on why Tesla's growth story is dead according to these guys. Statistically speaking, the Tesla growth story has stalled out. For a moment, let's put aside specific catalysts and headwinds and focus on a company's rawest measure of success, its earnings per share. Between 2019 and 2022, Tesla's automotive revenue more than tripled to $71.5 billion, and its adjusted non-GAAP EPS catapulted from 1 penny to $4.07. It was every bit of a game changer as Wall Street expected it to be, with historically low interest rates and fiscal stimulus during the pandemic assisting its outperformance, at least in those guys' opinion. That helped. I'm sure it did help out some, but there was a lot of things going on that made Tesla's performance great. But based on Wall Street's consensus EPS estimates, the 2022 to 2025 stretch tells a completely different story. After reporting $4.07 in EPS in 2022, the company's per share profit declined by 23% in 2023 to $3.12. For context, EPS estimates for 2023 entered the year above $6 per share, which means they were halved over the course of 12 months, which is exactly why I hate whenever people project out into the future and have all these spreadsheets and graphs and all this other crap like that, because you can't predict things of that nature. It's the same story for Tesla's 2024 and 2025 consensus EPS, which currently sits at $3.05 and $4.06 respectively. Wall Street's 2024 forecast has come down from a peak of over $7 per share, while the $4.06 expected in 2025 has also been slashed by more than 50% over the past year and change. Although earnings estimates are subject to revision, of course they are, Wall Street is expecting one of the leading growth stocks over the past decade to go absolutely nowhere. Basically $4.07 in EPS in 2022 and $4.06 in EPS in 2025 through the mid-decade. To be fair, the entire EV industry has hit its first true speed bump. Higher interest rates have made borrowing money and financing new EVs costlier, and additionally, EV infrastructure still isn't widespread, which serves as an industry-wide deterrent. But as the world's most valuable EV company by market cap, it's Tesla's glaring flaw that stand out the most. All right, so when we look at something like this, I can't argue with what they're saying at that stage in regards to growth. When you get down, I don't care about fair or not fair, and everybody's saying that's not fair, that, this, that, and the other. Calm down and try to view it as an investor, try to view it as somebody who is managing, millions, hundreds of millions, maybe even $1 billion plus in money. When you're looking for stocks to invest in, seeing EPS decline is not a good sign, and it absolutely means that there's at least a stall in the growth rate. Now, it doesn't mean the growth is dead. It absolutely means it stalls, and when you see constant revisions down and then Tesla beats, that right there is why I say in a lot of my videos where Tesla has a beat, and I say, well, yeah, it kind of was, but it kind of wasn't because they revised down so much. That's how Wall Street's viewing it. That's the view I'm trying to give you guys here and give you guys that proper context, because a lot of folks will be all kinds of upset. Oh, they double beat by a lot. And it's like, well, kind of not, because they actually had to readjust their guidance in the first place. Now, I'm not saying other companies don't do it. I'm not saying that it's an indication of bigger problems. Sometimes it is, and that's why you got to dig deeper and look deeper, because there are companies where that EPS declines and there's a bigger problem there. We all know exactly why Tesla's doing it, but in regards to this point kind of on its own, as it stands, I can't argue. EPS has been declining, and when you get an EPS number that basically goes flat for 3 or 4 or 5 years, that is essentially no growth at that stage. Now, it doesn't mean growth story is over with, but again, just looking at it, the numbers don't lie, guys, so we got to be honest there. Let's talk about the next point here that they jump into. Tesla has officially lost its luster. Tesla's problems truly became recognizable last year when the company began aggressively reducing the selling price of its 4 production models. While shareholders were hoping that these price cuts were the result of production efficiencies, and yes, I'm not going to argue that piece there, Musk made clear during the company's annual shareholder meeting in May that his company's pricing strategy is dictated by demand. With Tesla continuing its price reduction strategy into 2024, it's a crystal clear indication that EV demand has waned and inventory levels have risen. Okay, it's another one there I can't argue with. I can remember distinctly, and again, blast me if you want to, guys. It doesn't matter. But I remember distinctly when we started seeing the cost cutting happening. Although I agreed with it, I understood the reason why. I agree with trying to take market share and trying to sell every car that you do. I agree with the strategy completely. But I can remember people saying, oh no, the EPS number is not going to go down because Tesla's getting so much more efficient that they can cut the prices and still keep the margins up over 20%, still have all this incredible EPS. And that hasn't played out, unfortunately. They were not able to gain enough efficiencies to offset the price cuts. I've also said from the start that with Tesla, until it's not 90+% of all revenue comes from the car company, it's going to be subject to the macro factors that affect the car industry in general. So when interest rates are higher, the whole car industry suffers. And I remember saying that as rates were going up. And again, a lot of folks were out there saying, no, Tesla isn't a car company. It's this, that, and the other, and it's not going to affect them. And that's turned out to be not true as well. So both those points are very, very valid. Now in the future, I believe you're right. And I'm with you guys. It won't be as cyclical because they won't be dependent upon all that revenue and all that money to make their bottom line profit number. They're going to have a lot of other things there, but they are not there yet. They're not even close to there yet. So we have to calm down and look at the facts and the reality that are right in front of us there. So again, this is another point. Unfortunately, I can't argue with this specific point on its own by itself. Another problem for Tesla is that its ambitions to become more than just a car company are falling flat. Sales growth from its energy generation and storage segment have fallen off, while gross margin for the company's services segment clocked in at less than 3% during the fourth quarter. While Tesla has enjoyed spurts of success, the acceptance of its supercharger network among legacy automakers, it has been prone to failures such as the acquisition of Solar City. All right, so we came to our first point here that I disagree with. Parts of the energy business are absolutely booming and taking off, and they were just flat out wrong there in their quote. They just were. That right there is wrong, false, whatever the heck you want to say out there. They are wrong in that particular aspect. The energy business has done great. Now, the point about solar, I've been saying for more than a year now, maybe even 2 years now, they need to dump it. It's just one of those things they can't figure out. They haven't been able to figure out. It's just all the way around. It's just not a product that they can figure out. They need to basically either get rid of it or completely revamp it, do the engineering thing that Tesla does, or focus on some of the other things that are going to be far better margins and be just a better product overall, and forget about that piece. So with the solar piece, I agree with. Energy overall, they were just flat wrong. And hey, this is Wall Street, guys. This is what they do. All right, moving on to the next point here. The quality of Tesla's profits and cash flow also need to be called into question. During the third and fourth quarter of 2023, the company generated a respective 41%, 35% of its pre-tax income from a combination of regulatory credits that are sold to other automakers and interest income from its existing cash. This is an outsized percentage of its pre-tax income coming from sources that simply aren't sustainable and aren't representative of its EV sale leasing operations. With regards to free cash flow, Tesla generating roughly $2 billion in 2023. If its $1.81 billion in stock-based compensation were backed out of the equation and its interest income and regulatory credits fully taxed, the company's free cash flow would effectively disappear. All right, so a couple things I agree with, a couple things I disagree with here. I strongly disagree with the fact that when you're saying that it's a product, interest income shouldn't count or is not a big deal and it doesn't come from their operations. Every single company out there with a lot of cash on the balance sheet, which one is a great thing to have, right? You want your companies to have giant loads of cash there earning you interest. So saying that that's not really fair to count that in there and that's a kind of a negative too. I don't know what the heck is Warren Buffett's company making in terms of cash and money from their cash equivalents that they have. So to me, that's just silly. Apple with its giant cash pile is earning tons and tons of money. So is Google. So is everybody else that has giant cash piles. So to just use that as a bear case against Tesla, but then count that as a bull case for other stocks out there, it's just silliness at this stage. And this is more Wall Street trying to quote unquote manipulate the data and such. And yeah, although I don't like the regulatory credits either and how they're done, the reality is they figured out a way to make money off of it. And I don't see that changing anytime soon. Now, if we get a definitive, hey, this is the date that everything ends and all that sort of stuff, and there's no chance of that getting pushed out further or anything else like that, okay, now we can have a discussion and there might very well be an argument there. But until that time, it's just another tool in the toolbox that accounting rules allow them to use. And so why wouldn't they use it at that stage? And again, they used Wall Street speak. So they said it's an outsized percentage, but they didn't give you the percentage, nor did they tell you what a normal percentage is, because then you could compare it against other companies and see that they're full of crap. So again, more of these games, things that kind of happen with these type articles and such. This is also an example of one of the bear articles like I was talking about from the SoFi video yesterday. Same exact thing, giving you the bull and the bear case, and then they're right either way the stock goes. All right, moving on to the final point here. CEO Elon Musk deserves blame as well for Tesla losing its luster. Despite being an innovator, Musk has found himself in the crosshairs of securities regulators on more than one occasion. Perhaps worst of all, the vast majority of Musk innovations have failed to get off the ground. He promoted Level 5 full self driving as being 1 year away for a decade and failed to deliver on a promised 1 million robotaxis. Backing out Musk's numerous unfulfilled promises would wipe away the bulk of Tesla's market cap. Tesla's otherworldly valuation of 65 times forward-year EPS suggests it's one of the most revolutionary companies in our time. In reality, it's a profitable but still cyclical car company that's trading at roughly 10 times the forward earnings multiples of Ford and GM. It was fun while it lasted, but the Tesla growth story is officially dead. All right, so let's break this one down here one by one because there's just, I don't know, there's a lot of stupidity in there. So let's kind of look right there at the first one there. I don't know. Elon hasn't been in trouble with regulators here recently. He has in the past. We haven't had any issues with regulators lately. Compensation was a different deal. That wasn't regulators. That was a compensation thing going on there. So we really haven't anything to complain about that for a while. So thanks for bringing up an old point there. And the vast majority of Musk innovations, um, I, I don't know. These aren't the vast majority. There's a lot of things out there that are still to be seen. Now, I agree. I think it's total crap that we're a decade into full self-driving being next year and it still isn't here. Same thing with the robo taxis and a lot of the other things that people get ahead on. And actually, I will say this. He said the same exact thing with Optimus when it first hit. He has backed off a lot of that sort of stuff. The past couple of earnings calls, I can say definitively, the past two, he has given much more realistic timelines. The whole, hey, it's here, I'm working on it, surprise, and it's going to be here next year. He stopped all that after Optimus. Everything that's come forward since then, all his new estimates have been much more reasonable to where I can sit down and go, okay, I don't have to use voodoo sauce in order to figure out if that's a reasonable timeline or not, like I would have if I was thinking about something, like Optimus being, the next year away or something like that. So I love the fact that he has actually cleaned up that language. I can't disagree with the fact that he shouldn't have done it in the past and that was, being overly optimistic is hard for us as shareholders. But looking at those things like full self-driving and everything else doesn't mean the market cap should be wiped out. That's the dumbest thing, one of the dumbest things I've ever read, to be honest with you, because it's just silly. Really? Oh, it's a profitable, right now it's profitable making EVs like crazy, but because Robotaxi's not here and because FSD isn't here, well, you just get rid of all the market cap there. That's just dumb. I don't know where this guy's going with this. This is why I hate these type articles from Motley Fool or, Seeking Alpha or whatever the case is. I don't care. And 65 in terms of the future EPS is not terrible. It's not a terrible multiple. I agree that whenever, you get up over 1,000 like we were before, that's ridiculous. And that's where you're pricing in all this pie in the sky type stuff. But in regards to this, it's reasonable. If somebody wants to put it at a 40 instead, okay, I'm all right with that. But then comparing it to Ford and GM is just silly. I understand that even if I want to tag it as an automaker, it doesn't look like the rest of the automakers when you look at the financials. And what I mean by that is like, let's say I'm looking at, take your pick of whatever industry, NVIDIA, AMD, and I don't know, pick a couple other chip makers there. There's several of those companies to where if you didn't know the numbers, and I showed them to you, the balance sheets and the income statements and all the financials look very similar. Obviously, you can see the growth rates for NVIDIA are just incredible and lapping everyone. But in terms of the quality of the balance sheet and the income statement, they're pretty good overall. They look very similar in terms of quality, all those other things like that. They look very, very similar. You'd be hard pressed to tell which one was which company if you didn't know what the companies were and you were just looking at them. You couldn't tell. But if I sat down with Ford, GM, and Tesla's financials, one stands out as this incredible, doesn't look like it. It looks like, oh, hey, you didn't give me car companies here. You gave me, a tech company and then a couple of car companies here. These don't look the same here. You mixed it up. That's exactly the difference. That right there is why Tesla, comparing it, saying it should have a, 10 multiple or whatever multiple you want to put on 5. I guess that's where GM and Ford are. It's just stupid because they're not even the same companies in regards to the quality of the financials. And again, in the end, that right there is what we're looking at, is the quality of the financials in regards to the company there. So again, another just dumb narrative that, hey, I got it if you don't like Tesla. I agree. Some folks get out there and they think an 80 PE is reasonable or 100 is reasonable, which I don't personally think those sort of things, or 1,000 was reasonable or 500, whatever number you want to put out there. I agree. And I understand that pushing back against some of that narratives is very, very helpful. But then when you go to the opposite extreme like this, it's just silliness and it's not worth your time, guys. But more importantly, and this right here is what I want you guys to understand. This right here is key to it all. Wall Street is short-sighted. And in the short term, I would agree. Tesla's growth for the next, couple quarters at least, according to Elon, is going to be flat. It's going to be quote unquote, I wouldn't call it dead because that means it goes to zero, but it's going to be flat. It's going nowhere. Doesn't look impressive. You want impressive, go look at Nvidia. Look at their growth numbers. Ridiculous. Out of this world. Incredible. But it's not happening with Tesla this year. However, that means nothing in terms of, 3 years from now, 5 years from now, what's the growth going to be like? If it's still going to be down then, okay, at that stage, you could make that call. But in regards to a cyclical shift in the business and Elon making decisions to keep market share and keep taking market share during that time frame, to me, is just smart strategy, not perfect strategy, not the greatest of all time. And he's playing, 16D chess and everybody, whatever. I don't get into all that sort of stuff, but it's a smart business move that is going to allow them to have a bigger growth push in the future whenever we come out of this. And it's not like Tesla isn't working in the background either to make a lot of these things better, to get more efficient, to put more products out there and do a lot of other things like that. So just typical BS from Wall Street. Ignore it. You don't need any of that in your life. That's why I stay away from all this sort of mess, regardless of what it is. And we have massive things coming to my group. So if you want to see my buy and sell alerts on Tesla, if we get there in real time, you want to take 5 courses for free, be a part of the best 6, 7, and 8-figure Discord out there, use our stock analyzer tool for free. We have coaching coming. We have all kinds of things coming to the group there. Make sure you check out the pinned comment and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.